OG Macro AG here. Let's slow this down and walk through it carefully, because tonight's Asian opening isn't just another session. It's a stress test, a pressure valve, and potentially a decision point for precious metals, broader risk assets, and global liquidity. No hype, no predictions. Just structure, probabilities, and data-driven thinking. Take a breath. Let's start at the top. Over the last 24 to 72 hours, we've seen extreme disorderly price action across multiple asset classes. Silver moved violently, double-digit percentage swings inside compressed time windows. Gold followed, not with the same amplitude, but with unusual speed and correlation shifts. Equities sold off, bounced, sold again. Crypto delevered sharply. Volatility spiked, not gradually, but suddenly. This is not normal two-way trade. This is forced flow. When markets move this fast, especially across traditionally uncorrelated assets, it's rarely about new information. It's about liquidity stress, margin pressure, and the mechanical unwinding of leverage. And when that happens, the Asian session becomes critical, because Asia doesn't trade sentiment first. It trades physical flow, balance sheet reality, and settlement constraints. Tonight matters. Let's address the bounce, because a lot of people misinterpret these. Silver drops hard, gold follows. Then suddenly, a violent snapback. Silver up high single digits, sometimes double digits intraday. Gold reclaiming key handles quickly. This is not confirmation of anything. These bounces usually come from three sources: short covering after margin liquidation, volatility-based positioning resets, liquidity pockets, where selling simply exhausts. In silver specifically, the market structure amplifies this. Silver is thinner than gold. It trades with more leverage. It has a higher paper-to-physical multiple. So when liquidation hits, it overshoots. And when forced selling ends, it rebounds just as aggressively. But rebounds during liquidation cycles are not trend reversals. They are breathing points. The question is not, did price bounce? The question is, did liquidity normalize? Did spreads tighten? Did physical premiums collapse or expand? Did inventory drawdowns accelerate or stabilize? Those answers don't come from New York alone. They come from Asia. Let's be precise here. Technical levels do not predict outcomes. They signal stress zones. In silver, the recent low represented a multi-year support range where open interest historically compresses. The bounce stalled near a prior breakdown zone, not randomly. Volatility-adjusted ranges expanded to levels typically seen only during systemic events. In gold, the key zone isn't the bounce high. It's the settlement behavior around prior all-time closing levels. Gold didn't collapse. It repriced volatility, which is different. That tells us gold is still being treated as a balance sheet hedge, not a speculative asset. But here's the key. When technicals matter most is after forced selling ends. If Asia rejects the bounce, that tells you liquidity stress is unresolved. If Asia absorbs metal, tightens spreads, and pushes premiums higher, that tells you something else entirely. This move has all the hallmarks of a liquidity event, not a macro thesis shift. Let's break it down. Rising funding stress. Higher margin requirements. Cross-asset correlation spikes. Assets sold regardless of narrative. That's classic leverage unwinding. Funds don't sell because they want to. They sell because they must. Silver and gold get hit not because they're wrong, but because they're liquid. This is crucial to understand. During liquidity stress, good assets sell with bad assets. Correlations go to one, cash becomes king temporarily, and once leverage is flushed, then the market reprices fundamentals. But that repricing begins where physical demand still exists. Again, Asia. This is where most people lose the plot. Paper prices fell fast. Physical markets did not respond the same way. In many Asian hubs, retail and wholesale premiums rose, not fell. Delivery delays extended. Bid-ask spreads widened, but did not collapse. That's a divergence. On COMEX and LBMA, open interest dropped sharply. Contracts rolled or liquidated, paper liquidity evaporated briefly. But physical metal didn't flood the market. It stayed sticky. That tells you the selling pressure was financial, not supply-driven. And when financial selling ends, physical markets tend to set the floor. Let's talk about Asia specifically. Shanghai gold premiums historically act as a stress gauge. When premiums turn negative, demand is weak. Go flat, market is balanced. Spike positive, physical demand is absorbing stress. During recent sessions, gold premiums remained positive. Silver availability tightened in certain regions. Physical arbitrage did not collapse. That's important. Asia trades metal for ownership, not leverage. If Asian markets open and premiums expand, volumes increase, delivery demand rises, that suggests the West just liquidated metal into stronger hands. If premiums compress sharply, then we're not done yet. Now let's talk ratios, because ratios strip out emotion. The gold-silver ratio spiked aggressively. That tells us silver was liquidated harder than gold. Risk-off behavior dominated, speculative positioning was flushed. Historically, extreme spikes in the ratio occur near stress lows, not euphoric tops. But timing matters. Ratios can stay extreme longer than expected. Mining ratios also moved out of alignment with spot prices. Miners sold harder than the metal. That implies equity risk, not metal rejection. Inventory ratios, registered versus eligible stocks, tightened. Vault outflows continued, not reversed. No surge of metal back into storage. That's not a market rejecting precious metals. That's a market repricing leverage. Crypto didn't lead this move. It confirmed it. When crypto sells off hard alongside metals and equities, it's usually a sign of collateral stress. Funds use crypto as liquidity margin buffer, volatility exposure. When crypto gets sold into weakness, it often means margin calls are spreading. Equities followed a similar pattern. Sharp sell-off, mechanical bounce, weak breadth. None of this signals confidence. It signals damage control. Zooming out, nothing structurally improved. Debt levels didn't fall. Fiscal deficits didn't vanish. Policy clarity did not increase. Central banks are trapped between inflation persistence, financial stability risk. That uncertainty raises volatility, and volatility punishes leverage, which is exactly what we're seeing. This is not a normal correction. This is a reminder that the system is fragile. Let's lay out scenarios, not outcomes. Bearish continuation scenario. Asia rejects the bounce. Physical premiums compress. Liquidity stress persists. Gold revisits lower consolidation zones. Silver retests or marginally breaks recent lows. This scenario implies the unwind is not complete. Bullish stabilization scenario. Asia absorbs supply, premiums expand, volatility contracts. Gold holds key settlement levels. Silver stabilizes relative to gold. This scenario implies forced selling is largely finished. Notice, neither scenario promises upside or downside. They describe conditions, not certainties. Don't watch headlines. Watch Shanghai premiums, COMEX open interest, LBMA inventory trends, gold-silver ratio behavior, volatility term structure, funding stress indicators. Price comes last, flow comes first. Here's the bottom line. This move wasn't about belief. It wasn't about narratives. It wasn't about bullish or bearish. It was about leverage. Asia tonight will tell us whether stress is being absorbed or stress is still spreading. And until that's clear, certainty is a liability. Stay analytical. Stay patient. Stay aware of risk. Markets don't reward conviction during liquidation. They reward discipline. Stay sharp. Watch the data. Think independently. OG Macro AG out.